So why is everyone talking about Blink charging stock? Well, it could be for a number of reasons, namely being that it's such a fast growing company with such a long running tailwind regarding the electric vehicle industry. But what I wanted to do in this video is take a look at some insights I picked out from a question and answer session that Blink Charging Management held with Wall Street investors. I found some really key insights from this conference call. So let's dig into these details. You're not going to want to miss this if you're interested in Blink Charging stock. So starting with William Jellison from D.A. Davidson asking about the reliability of charging stations. So the founder and chairman of the board and the CEO, Michael Farkas, comes in and answers all the Gen 1 equipment was not made to par, and the reason why it wasn't because we didn't really understand the terrain. There's been a lot of improvements with the generational changes of hardware over time. I'm not going to say we haven't had any issues. We've had issues, but most of the issues that Blink has had has been with the prior generation equipment and network prior to when we bought the company and took over those assets. And namely that DC fast chargers are a lot more complicated and require a lot more maintenance. So essentially, the CEO coming out and acknowledging the question that yes, we've had some reliability issues, and that's to be expected when you're coming out with this innovative technology that really very few people have tried before, and it's really cutting edge. So you're going to have some hiccups. That's understandable. It's just now the question is how quickly can you innovate, incrementally improve those things that you learn from prior generation models, and incrementally with each next generation technology, how quickly can you improve? That's going to be the question. The president and director jumping in and saying definitely the complexity of DC chargers is 5 times what it is in the L2 charger. Blink is definitely focusing on making sure that we deliver the highest level of quality. And this is unfortunate because it's the fast chargers that consumers really want, and unfortunately that's what Blink charging has the most difficulty with because they're so much more complicated. And that's really the friction point, one of the main friction points to get consumers to switch from ICE cars to EVs is that much longer time to refuel and recharge. You're looking at 20, 30 minutes sometimes when you could go to a gas station and fill up your tank in like 5 minutes or less. So that gap, as well as some price differences, is withholding the growth of electric vehicles. William Jellison following up, asking about the capital offering now successfully completed. I'm curious how Blink is thinking about capital allocation moving forward. So, um, if you're not aware, Blink Charging on early February raised another $100 million by selling stock. So this analyst wants to know how Blink Charging is planning to use that $100 million that it raised in that equity offering. So the CEO jumping in to say, we know that there's literally billions and billions of dollars that are now going to be earmarked for our industry. So the capital we raised was really a bridge to get us to a lot of that funding. So we're going to look to use this money, the capital that we just raised, to really handle the operations and to grow our business. And management had said in other parts of this conference call that the money they raised is going to be enough to get them through 2024. And if they hit their milestones, if they make progress, if they make the progress that they've told analysts and investors that they're planning on making up until that point, it should be easier for them to raise capital at the end of 2024 after making all of that progress. However, if they experience headwinds and if they push out some of the targets that they said they were going to achieve by that time, then it's going to be more expensive and more difficult for Blink Charging to raise capital at that point in time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. The next analyst, Craig Irwin, talking about the eightfold increase in network fees in the quarter and what are the margins on those and what's driving growth there. And the CEO again jumping in saying this is recurring fees of selling energy and other services. And when we sell a charging station, we get a network fee every single month paid by that property owner. So that's really lucrative. And again, the growth trajectory of this industry is massive. Look at this. You're talking about 300 to 400 million, 500 million charging stations needed by 2040. We're lucky if we're at the tens of millions of charging stations right now. I think the latest estimate management gave was that there are 14 million charging stations right now, and there's going to be needing upwards of 400 million charging stations, right? You think about all the gas stations in existence today to support all the cars that are out there. Well, that's as common as gas stations are. That's pretty much how common charging stations are going to need to be by 2040 because it's going to switch over to where it's going to be, it might be by 2040 where it's 90% electric vehicles on the road and just 10% ICE cars. So you might see that big switch, and as it's happening, we're going to need more and more and more charging stations to support that growth in electric vehicles. But the margins, and to address what you're referring to on the margins of that business, on the processing fees, on the networking fees, they're massive. Okay, that's good to hear that they're massive. But I think the analyst would have liked to have heard, and as an investor, I would have liked to have heard an actual number here. Maybe not even just a specific number like 50%, but maybe a range like 50 to 60%, something like that, instead of just saying massive. Because I don't know what massive is. What's massive? 40%, 50%, 60, 70, 80? I don't know. And when I'm trying to create a financial model to forecast the profits, I can't put in my model, I can't put in Excel massive, right? I need to put a number in there. So it's a little bit um, disappointing that that management chose to use massive instead of giving an actual number. Okay, so that's all I've got for this video. If you enjoyed this video, I've hand selected a few others that I think you will enjoy. So please click on one of those and I will see you over there. Thank you so much for watching.